Before we start this video, do like and subscribe to our channel and not miss on any updates.
So dear friends, the AFM paper for September 25 was super easy. There were a lot of, people were actually very scared before the exam. But then when finally the paper came out, it was very, very easy. MCQs, practical questions, everything was easy. Some theory questions may obviously, there are some pluses and minuses here and there. But then point was it was very easy. And some questions obviously were direct from the material, but quite a few new type of questions, new variety of questions, probably something which has not been asked in the last 10 attempts, 7 attempts, or 8 attempts, right? Completely different. Probably they were asked about 7, 8 years ago. We don't know. But largely, quite a few questions were novel. Okay. Now let us look at the paper review in terms of what are the answers for all the questions. So I have already solved them, and this particular PDF is available in the description below, where the link for this particular PDF is available. That is the first part. Second part is, of course, do like, share, and subscribe to my channel. Do like and share this video, subscribe to our channel, and keep to stay updated. So first one is a super simple question on this one was on advanced capital budgeting. This one was on advanced capital budgeting, and in this, right, they gave initial project cost, then annual sales, variable cost, fixed cost, project life, and cost of capital. Cumulative present value factors given for 10% and 11%, and they've said ignore depreciation and taxation. Calculate after 2 decimal places. First one, if in project cost is varied adversely by 10%, what is the percentage change in NPV? Project cost is how much? Project cost is 4,80,000. So instead of 4,80,000, if it becomes another 48,000 plus, that is about 5,28,000. So what you get is 4 lakhs of expenses. 4 lakhs of revenue minus 2,20,000, which gives you 1,80,000. That you multiply it with the present value factor of 3.169, you get 90,420. So this 90,420 will reduce by 48,000. So you divide the 48,000. What is that? If the initial project is varied adversely, what is the change in NPV? So you do 48,000 divided by 90,420. You'll basically get 53.085 or 53.09. This is the first answer. Second one, same way. If annual cash flow is varied adversely by 10%. So annual cash flow here, initially some may have a doubt. Are we referring to the sales or are we referring to the net annual cash flow? Here net cash flow is 180 per annum. So you have to work out on both only then, because even when I was solving it, I was not really sure whether they were referring to sale number or this number. You solve both and you'll realize that they are referring to 180. And this 180 goes up by 18,000. Then comes down by 18,000, not goes up. It comes down by 18,000. So 18,000 into 3.169 is basically 57,000. So your NPV of the project reduces by 57,000. So 57,000 by 90,420, you'll basically get 63.08, which is or 0856, which is this the answer. Then cost of capital is varied adversely by 10%. So cost of capital here is 3.169 versus 3.103. So 3.169 minus 3.103, you basically get 0.066. This 0.066 will have an impact on this 1,80,000. You will basically get 11,880. So 11,880 is going to be the reduction. 11,880 is going to be the reduction in the NPV of 90,420. So 11,880 by 90,420, you get 13.138 or 13.14. Very, very simple. In fact, you need not even do massive computations at all. Very simple. Then case scenario 2, fair return mutual fund made an issue of 5 lakh units of 10 rupees each on 1st April. No entry load. Fund made following investments. So here they invested 100 rupees each at 160, which is basically 40 lakhs. Then government securities at par 4 lakhs, debt 2,50,000, debentures 2,50,000, total 49 lakhs. So even though they made an issue of 5 lakhs of 10 units, 10 rupees each, which is basically 50 lakhs, they invested only 49 lakhs. So basically you have to remember that 1 lakh is basically your cash value. During the year, dividend of 6 lakh was received on equity shares. Interest was received as and when due. So you have to basically assume that all 3 interests have actually been received. That is what is the meaning here. Okay. And operating expenses paid is 2,50,000. At the end of the year, equity shares and debentures are quoted at 175 and 90% of the face value. So please remember. So what happens here is this 160 is now becoming 175, and this listed debentures, right? They said, what is the other one? And equity shares and 10% debentures are quoted 90% of face value. So whatever you have taken, and this is already at par. So this is quoting at 2,25,000. So there is a reduction of 25,000 in this. Right. Now, what is the first question? What is the net cash balance of mutual fund? What is the net cash balance? See, opening you had 1 lakh cash. So to 1 lakh cash, plus 1 lakh minus plus 6 lakhs you have received dividend, then minus expenses of 2.5 lakhs. Then you also received all the interest, everything that is due. So 7% on 4 lakhs is 28,000. So plus 0.28 plus. Then 9% on 2 lakh 50 is 2.25. Sorry, 0.225, yeah? Not 2.25, 2.225. And 10% on 2 lakh 50 is 0.25. Everything I'm writing in lakhs. So if you add all of this, you get 1 plus 6 minus 2.5 plus 0.28 plus 0.225 plus 0.25. You get 5.255. This is the answer. Very simple. Then what is the NAV of the mutual fund at the end of the year? So what is NAV? Your assets plus cash balance, if any. So you have to find out the value of the assets. What is the value of the assets? Here you have this one, no? Whatever is 40 lakhs. This has grown from from 160 to 175. That is what we identified. So 25,000 into 175 is equal to 43 lakh 75,000 plus these two are quoting at the same number. Whatever is at par, this 10% debentures is quoting at 2 lakh 25,000. So plus 4 lakhs plus 2 lakh 50,000 plus 2 lakh 25,000. This is your value of assets. And so value of asset is, this one was 5 lakh 25,500. Value of asset is 52 lakh 50,000. And this is 5 lakh 25,500. If you add both, you get 57 lakh 75,500. This is the answer. Okay. Then fund distributes a dividend of 0.6 per unit in the year to unit holders. NAV will be what? So how many units are there? We have here 5 lakh unit. 5 lakh into 0.6 is 3 lakhs. So if you are going to distribute 3 lakhs, what is the value of the assets here? 57 lakh 75. So minus 3 lakh will give you 547 5500. That you divide by 5 lakhs. Why 5 lakhs by? Because it is here, they initially said the issue of 5 lakh unit. So you divide by 5 lakhs, you get a value of 10.951. Okay, this is done. See, everything was super simple. In fact, very little, extensive working is not required. Very little working and you're moving forward very fast. HHM is a famous consultant, established following strategy on stocks of PLS, purchased one 3-month call option with premium of 25 and exercise price of 750, purchased one 3-month put option with the premium of 8 and exercise price of 600. So one call, one put. Okay, stock is currently trading at 680, option size is 100 shares. From the given information, choose the correct answer. So in all these questions, now one thing you notice, I'm actually reading the case and then going to the questions. Ideally, what did I tell you? Read the questions and case, but all the cases are so small, hardly 7 lines, 10 lines. Okay, what is the net gain or loss? The price of the stock remains at 680. See, in a call option, you have a right to buy if it goes up, right? Or you will exercise your right to buy if it goes up. So you have a right to buy at 750, but it is already at 680. Same way in put option, you have a right to sell at 600. But the price is already 680. So both of them will expire worthless. So what will happen? Whatever premium you paid, how much premium? 25 here, 8 here. So totally 33 into 100, 3,300. So your loss will be 3,300. Then what is the net gain or loss? If price of stock falls to 500. So if price of stock falls, on call you will not make any money, but on put you'll make money. What is the put ka payoff? Put ka payoff is at, or strike price is at 600. When market is at 500, you're with 600. So you basically make a 100 rupees profit. On how many lots? 100 lots. So 10,000 rupees. So 10,000 minus whatever is the premium that you have paid. So basically 6,700 is the net gain. Then if the price rises to 820, price rises to 820, your call is at what? Call is at 600 and something, no, 750. So call is at 750. So 750 minus 820 or 820 minus 750 is 70 bucks. So on this 70 into 100, you make 7,000 minus you originally invested 3,300 as premium. So net profit is 3,700. That's all. Right. Super simple. Then on 3rd April, Royal Bank got the following quotes: bid, ask, 4 decimal. Please be very careful. 2-month swap points. When they say swap points, they've also very clearly defined. One swap point is equal to 0.0001. That is basically you're referring to the last 2 decimals. Okay. 2-month swap point, 3-month swap point. And please note, bid is less than ask. Very good. In swap transaction, delivery is made after 2 days. Okay, no problem. Assume spot rate on 5th April is so and so. Calculation up to 4 decimal. Okay, from the information given above, choose the correct answer. What is it? Swap point for 2 months and 15 days. That is for 20th of June. So when you're saying 2 months and 15 days, you are basically saying that anywhere in between these two. So when it is between these two, you take 60 plus half of the difference. So 60 plus 150 minus 60 by 2. So the difference between these two is 90, right? So 60 plus 45, you get 105. And same way 80 plus, you have here 49. So you get 129. So bid is 105, ask is 129. Very simple. Then foreign exchange rate for 20th June. What will be the rate for 20th June? You just simply add these two. No, that's all. Nothing else. You add this 105 and 129 bips here. So you add 105 here and 129 here. So 84.2630. Which one has 84.2630? Yes, 26. Only one of them has. So you need not even do the second one. First one say you got the answer already. Right. Then on average, what will be the rate of premium discount on Indian? So when they're saying on average, right, basically they want, and they've given bid ask separately. So what you should do is, you should take this 105 and 129 and use that to compute. And this 105 and 129 are for what period? They are for 2 months, 15 days. Right. So what you do is 0.0105. This basically is the swap points, right? Divided by 84.2525. Okay. You get one number. But you need it annual. So you multiply by 12 divided by 2.5. So you'll basically get 0.000598, 0.000598, and you do it into 100. So you get 0.05982. So you have 0.0598, two of them are there. Okay. But what are they asking? What will the annual rate of premium or discount of US dollar on INR? That is dollar at a premium or discount? See, boss, you're adding a premium here to INR exchange rate. So basically dollar is at a premium, INR is a discount. So this premium number, whatever you got, 0.0598 is a premium. Okay, it is premium of dollar. It is not discount of rupee. Okay, so it is premium of dollar. So you directly take this. Okay, fair enough. This is done. See, we are moving very fast. The MCQs were like super easy. I'm pretty sure there are a lot of people who are going to score 95 plus, 90, 100 or whatever also possible. Right. ABC is planning to acquire XYZ. Following information is available. ABC number of shares, market price, PE ratio, number of shares, market price, PE ratio. So moment I looked at this, right, when I saw number of shares, market price and PE ratio, first thing, PE is equal to market price by EPS, or EPS is equal to market price by PE. So 16 by 20, 0.8, 20 by 10, 2.0. Okay, first that is what struck me. Okay, and then also another thing that struck me, what is a PAT? What is PAT? Your EPS, whatever we got here, into the share count. So 0.8 into 12 is what? 0.8 into 12, 12 8 is 96. So 9.6, and your 2 into 4 is 8. So 17.6 lakhs is your PAT. Okay, ABC plans to acquire the whole of XYZ. So this is the acquirer, this is the target. ABC plans to acquire whole of XYZ by issuing shares in market price of 16. So you're going to issue at market price of 16 only. But it is expected the price of ABC will remain constant after this acquisition. Post acquisition also, the share price will be same 16. Purchase consideration is 80 lakhs. ABC is acquiring XYZ at 4 lakhs into 20, which is basically 80 lakhs. They're acquiring it at market cap. Now this 80 lakhs, you are acquiring by issuing 16 rupees worth share. So how many shares will you issue? 80 lakhs by 16. It's basically 5 lakh shares. You have issued 5 lakh shares. Now let us come back. Calculations up to 2 days once, no problem. From the information given, choose the correct answer. EPS of ABC and XYZ before acquisition already found out, 0.8 and 0.2. I computed it and showed it. EPS after acquisition. What is EPS after acquisition? Is PAT, post PAT by post share count. What is post PAT? See, basically you'll add both these PATs, which is basically 17.6. Correct, right? And you'll divide it by share count. How many shares are there? Originally they were 12 lakh. Now you should under 5 lakhs. So basically 17 lakhs. So 17.6 by 17. 17.6 by 17. You'll get 1.035, which is 1.4. Super simple. And then last one, PE ratio after acquisition. What is PE ratio? PE ratio is your price to EPS. What is price? Price they said is already 16. EPS we just now found out 1.04. So 16 divided by 1.04. You get 15.4545, or if you take exact number, you'll get 15.4545. If you take 16 by 1.04, you will get 15.38. 15.38. That's all. Over. Super simple, right? We managed to finish everything such a fast span of time. Now let us move to the next one. Now come to this descriptive part. Now in descriptive part also, I'm going to solve all the questions. I have the solutions here. I will show you the working. I'm not going to solve again, use calculator and all. You can actually have a look at the solutions at your free time. And please note, if you have any, if you think that there is something that I missed out, or there is another variety of assumption that can be made, or there is a very different interpretation that CA Institute has, please let me know. Some of you might start trolling, but please note, assumptions can be different, mistakes sometimes do happen, and ICA themselves may have a very, very different interpretation of it, or they may have solved it very differently in some other exam paper, things like that. Okay, chaliye, let's come and have a look at it. PN Limited submits the following details for financial year ended on 31st March. Number of equity shares is 1.5 lakhs. Current market price is 12. 10% debt is 2 lakhs, which basically means 20,000 of interest. Cash and cash equivalent is 5 lakhs. Gross profit is 12 lakhs. Indirect expenses is 5 lakhs. Depreciation is 30,000. Risk-free rate, market rate of return, and beta. Both of them are given. Applicable tax rate is given. Now, what are they saying? They are saying, after considering all of this, on the basis of the above, you're required to calculate the following: cost of equity using CAPM, EPS, equity value of the company if EBITDA multiple is 4, and enterprise value of the company. Calculation up to 2 decimals. Okay. First one will come to CAPM. What is CAPM? We all know what CAPM is. Cost of equity, basically your RF plus beta into MRP, 7% plus 0.8 into 16 minus 7, because they've given 16 as market return and 7 as risk free. You basically get 14.2 as the your CAPM cost of equity. Next question is what is EPS of the company? For EPS of the company, what do you have to do? You have to compute the entire P&L. So what are the items in the P&L? You have, what did they say, number of equity shares, gross profit. You start from gross profit because they're not given revenue numbers. You should take 12 lakhs minus OPEX 5 lakhs. They themselves have given OPEX excluding depreciation and interest. So that gives you OPEX of 5. So basically excluding depreciation interest. So the difference between those two is EBITDA. From EBITDA, you subtract depreciation 30K, which they have already given here. And then you subtract interest, which you already found out at 20K. So if you from 7 lakhs, you subtract 30K, 6.7 is going to be EBIT. From 6.7, you subtract interest 20, you're going to get PBT of 6.5. And tax rate is what? 20%. So from that, you subtract tax of 20% on 6.5, 1.3 lakhs. So you'll get PAT of 5.2 lakhs. This PAT of 5.2, we have to find out EPS. What is the share count? Number of equity shares is 1.5 lakhs. So 5.2 by 1.5, you basically get 3.47 as your EPS. So 3.47 is the EPS. Okay. Then they said equity value of the company, applicable EBITDA multiple. So they're asking equity value. They're not asking you enterprise value. Okay. Please be very careful. I don't know what interpretation institute will have, but I'll tell you what is the equity value, enterprise value. What is the EV? EV is your EBITDA multiple of 4 times. That's what they said, right? Because applicable EBITDA multiple is 4. So EBITDA into 4, we have already got EBITDA here of how much? Where is the EBITDA here? 7 lakhs. So 7 lakh into 4 is basically a 28 lakh. This should be your enterprise value. This is not equity value. Okay. EBITDA is a number that is applicable both for your equity and debt, because it is basically income that is still not deducted, from which you have not yet deducted your interest. So basically, this is an income attributable to both your debt holders and equity holders. So the value you arrive at it will be at value attributable to both equity and debt, guys. So it will be enterprise value. So if you have to arrive at equity value from that, you remember the formula: equity value is equal to enterprise value minus debt plus cash. So 28 minus 2 plus 5. Why minus 2 plus 5? Because they have given debt is 2 lakhs and cash is 5 lakhs. So minus 2 plus 5. This is the formula. If you do not remember, please go ahead and have a look. So your equity value will be 31. Yahan tak okay, no problem. Next comes the next one, which is what? Enterprise value. Enterprise value as per what? See, already we have found out enterprise value here as 28. That is one way. So 28 lakhs enterprise value is one answer. Other way of doing enterprise value is you based on market cap. You can do it on market cap. How will you do it on market cap? See, because they have given here. What have they given here? Current market price. So you have to write both the things. That is, EV based on EBITDA multiple is basically your 28 lakhs, what we already found out. But you can also find out an EV based on market cap. How will you find out EV based on market cap? You will find out EV based on market cap by doing this, which is what? You multiply your market price, 12 into your 1.5 lakhs. 12 into 1.5 is what? We did it here. I did it already. Market cap of 12 into 1.5 is 18. This is your market cap. From market cap, you subtract cash and add debt. What is cash? Minus 5 and add debt of 2. So 18 minus 3, which is basically 15. So you get enterprise value of 15 lakhs. So you have two ways in which you can find out the enterprise value. One is from the multiple that they've given, and one is back work, or rather work from the market cap that they've given based on the price of the share. Okay, these are two ways. Right, this is done. Now let us move to the next question. Okay, if you have any doubts, of course, please ping me on comments. or reach out to me on RAP OneFin by IndigoLearn. And of course, do like, share, subscribe to this channel, subscribe to my videos, and please do stay updated. Then KK Limited is operating in Japan, has today affected sales to Indian companies. So KK is in Japan. They have sold to Indian company called LM. The payment being due in 3 months from date of invoice. So they have made a sale today. It is due after 3 months. The invoice amount is 855 lakh yen. The invoice amount is yen. So the exporter is billing in their own currency, which at today's spot rate is equivalent to 500 lakh. So 855 divided by 500, basically 1.7. What does this mean? Is, see, 855 lakh yen is equal to only 500 rupees, meaning rupee is stronger. So 1 rupee is equal to 1.71. How do you get 1.71? 855 by 500. Okay. Looking at the present market conditions, it is anticipated the exchange rate will decline by 10%. Now, what do they mean by decline by 10%? Whether it will appreciate, depreciate. For whom? For, is it the importer, exporter? We don't know. Only when you read the balance question, you'll understand. In order to protect the yen payments, so we are referring to the importer. So the importer is worried that the exchange rate will decline. See, if let's say 1 rupee, and I'll give it a simple example. 1 rupee is, let's say, INR is 10 yen. Okay. So you've already been billed at, let's say, 100 yen. Okay. How many rupees you have to pay? You have to pay 10 rupees. Now, suddenly they say, 1 rupee is equal to 10 yen, exchange rate has changed. It has now changed to 1 rupee is equal to 9 yen. Okay. Now, 1 rupee is equal to 9 yen. What happens then? If 1 rupee is 9 yen, payment is already fixed at 100. How many rupees you have to pay? 100 by 9. Which is basically 11.11. So you are having to pay higher value in rupee terms if you make an yen import. When the payment is actually in yen terms, the reason is because yen is appreciating and rupee is depreciating. So in here, what has happened? Initially 1:10. Now suddenly it has become 1:9. So when you are looking at this, right, in order to protect the yen payment, importer proposed to take appropriate action. So he is worried that yen will appreciate. So the rate of decline of 10%, whatever they're mentioning, no, it refers to the fact that yen will appreciate. It is not to the fact that yen will depreciate. Okay, I'll show you one more evidence for that. The 3-month forward rate is presently at 1.6. We already found out 1.71. Now forward rate is at 1.68. What has happened? 1 rupee is equal to 1.71 yen. 1 rupee is equal to 1.68. What has happened to yen? Yen is appreciated, rupee is depreciated. So they are referring to yen appreciation of 10% from here, which is 1.71 into 0.9, basically 1.539. So they are worried it will become 1.539. You have to be very careful about this, right? And it is evident from these two last 3-4 lines. We are required to calculate expected gain loss under present situation. Expected gain loss if you hedge by forward contract. Recommend which is a better calculation up to 3 decimals. Okay, so payment is 855, 500. As I said, the exchange rate is 1.71. Exchange rate down by 10% means 1.7 minus 10% is 1.539. So how much payment will you have to make? You have to make payment of 1.539. 855 divided by 1.539. So 855 divided by 1.539 because your payment in yen is fixed. Okay, yen rupee exchange rate is changing. Okay, so you do yen by 1.539, you'll basically get 555. So you have to make a payment of 555 instead of original 500. Okay, so the loss is 55.55. Same way, if you take forward contract, you make yen payment of 855 by divided by 1.68 yen. So basically, if you look at this also, right, 855 yen into 1.68 yen per INR. So what will you do? If you have to, will you multiply with this or will you divide? You will divide so that yen gets cancelled and you get the value in rupee terms. So you divide 855 by 1.68, you get 5.08. 5.08929. 855 by 1.68. 508.92, not 5.08, 5.89.929. So the loss is 8.99. So which one is better? Option B is better. That's all. There's nothing else in this, right? Then let us move to the next question. What are the next? No, there was a theory question. What is the theory question? List the steps involved in business succession strategy, business succession planning, startup. That is what is the question. See, they have asked the question from startup also. Okay, what are the steps? You know, I'm not going to get into theory discussion. Next, Mr. X is holding 2,000 shares of PQR. Presently, dividend being paid by the company is 2.5. Presently, dividend being paid. Is it paid for next year? Is it last? So you have to assume it is previous. This is a fundamental mistake. I think 2 or 3 people ping me also. You have to assume this as D0. Okay, and the share is being sold at 45. Okay, very good. P0 is 45. Now, some of you might have made an assumption being paid can refer to next year's dividend. I don't know. On the face of it, to me, it appears as if it is P0, D0 was. Okay. Mr. X is concerned about several factors which are likely to be changed during the course of the year as indicated below. Risk-free rate, existing revised, market risk premium, market risk premium. This is basically your market risk premium is your return on the market minus risk-free rate. Beta, expected growth rate, all of them are changing. In view of the above changing factors, advise whether you should buy, hold, or sell the shares. Answers up to 2 decimal points. So, D0 is what I've assumed. D0 is 2.5, P0 is 45, shares held is 2000. So, what is cost of equity? How will you arrive at this? And they have not said openly what method should you use. So, you have to infer it that it is dividend discount model or government model. So, D1 by K minus G. What is D1? D0 into growth rate. Growth rate have they given? Yes, they have already given the growth rate. What is K minus G? K. What is K? K you have to find out. K is what your market return. That's a risk-free rate plus risk premium into beta. So you get 17.8 here, and into the revised scenario, you'll get 12.8. Basically, you're 8 plus 4 into 1.2. Right? You get 17.8 and 12.8. Now, what is P0? P0 is D1 by K minus G. So D1 is existing rate of 2.4 into 1.04 because the growth rate here is 4 and here it is 6. So 2.5 into 1.06 divided by KE minus G. What is KE? 17.8, 12.8 minus 4 minus 6. You will basically get 18.84 and 38.97. So what are they asking? They said in view of the changing factors, otherwise you should buy, hold, or sell shares. Okay, Mr. Shea is already holding. Now, under existing thing, his value is 18.84. Pehle to, at that rate itself, he should have sold. Okay, because market price is what? Market price is 45 bucks. Okay, it should have sold off, made money. Even under the revised scenario, it is 38 only. It is not more than 38. Okay, it is not more than 45 actually. So even in there, under both scenarios, it is overpriced, sell, sell, sell. Okay, this is the answer I've got. If you guys have any queries or doubts, please let me know. But the thing is, I assume this is D0 because on the face of it, it doesn't appear that it is D1. Okay, there is a very similar question in the, I think material, in my material P6 and plus also I've covered. There also we have considered like this only. It is, I think, from the SEP material also. Next, 2B. BM is considering to borrow an amount of 80 crore for a period of 3 months in upcoming 6 months time from now. So, basically, they are considering 3 months after 6 months, 0 to 6, 6 plus 3, basically 9. They're considering for a period of 3 in coming 6 months time from now. Current rate is 7%, but it may go up to in 6 months time. The company wants to hedge itself against the likely increase in interest rate. The company bank has scored an FRA at 7.3%. Okay, very good. Then you are required to compute the final settlement amount if the actual rate of interest during consideration is 7.6 or 6.8. Okay, show your workings on the basis of months and calculate up to 4 decimal places. They very clearly said go by month boss. Simple, super simple. Okay, so basically this is what I was saying. 0 to 6, after 6 months you'll borrow 80 for next 3 months, 9 months. Basically your FRA, right? And this, currently the rate is 7%, but what did they say? The FRA is at 7.3. So you're going to enter into an FRA at 7.3. So FRA is at 7.3, but the settlement rate can be 7.6 or 6.8. So if it is 7.6, what will happen? It's 6.8, what will happen? Basically, you have your 3 by 12, which is basically the months for which you will, the interest is going to be charged, 3 by 12 into 7.6 minus 7.3. See, why is it 7.6, 7.3 minus 7.3? Because you have agreed to borrow at 7.3, market rate has gone up. So you have made a smart decision. If you have smart decision, you will basically make money. That is why 7.6 minus 7.3 by 12 into 3 into 80 crores, you will get basically 6 lakhs. Okay, whereas in the other case where it is 6.8, where you made an unwise decision, you agreed to borrow at 7.3, whereas the market rate is already at 6.8. So you've lost 0.5%. So 3 by 12 into 6.8 minus 7.8, basically minus 0.5% into 80 crores by 12, you basically get 10 lakhs. Now, is this the answer? No. This is the value that you will make or lose with respect to interest, right? But when will this happen? This will happen on the 9th month. But this will happen at here. But we are on settlement date. What did they ask? They specifically said, compute final settlement amount if the actual rate of interest is so and so. Settlement happens on which date? Settlement happens on this day, 6th month, when the rates are announced. So you have to discount these particular cash flows to the for 3 months period to arrive at 6 months, to arrive at as on the 6th month ending. So 6 lakhs divided by 1 plus 7.6% into 3 by 12. Why 7.6? Because in this period, the interest rate is 7.6. Whereas here you will do 6.8 into 3 by 12. Okay. Because interest rate for the next 3 months is 6.8. And you do it 3 by 12. Why? Because the next period is 3 months. Okay. So you get 5,88,812 and 9,83,284. Okay. Here, please note one thing. If you do only till here and don't do this, you will lose marks. Okay. Please be very careful. Okay. Then identify key points that makes an organization financially sustainable. First chapter. Okay. Then TK has a 600 lakh 12% debenture outstanding with 5 years remaining to redemption. Okay. So what? Since interest rates are decreasing, companies plan to redeem these debentures with a 6 lakh issue of 600 lakh issue of 5 years. So again, refinance this with same tenure debentures at 10%. So old was 12, new is 10 at par. Issue cost of 10%, debenture will be 10 lakhs. Oh, there is a issue cost. Okay. Premium paid is 5%. 5% of what? 5% of outstanding value. So 5% of your 600 lakhs outstanding. 5% of 600 is 30. Okay. This is 30. Tax rate applicable is 20%. Now you are required advice on the 12% debenture redemption decision. They have given 10 and 8% present value factors, 8%, 10%. Why have they given 2 present value factors? Easy to confuse. So some students did it using 10, some students did it using 8, which is correct. 8 is correct. Why? Because your issue, the new debentures are issued at 10%, but then you also have a post-tax rate. The tax rate is 20%, so you have to discount everything at 8%. 10% minus 20%, which is basically 20% of 10. So you have to discount everything at 8%. So present value factor of 8 is what is relevant. Okay. Then calculation up to 2 decimal point is very simple. Okay, we'll ignore that. So what is happening here? You have 600 lakhs at 12% and 600 lakhs at 10%. So what is the difference? 2% on 6 lakhs, 600 lakhs. 2% of 600 lakhs is basically 12 lakhs, right? Basically, you have here 12 lakhs on 12% on 600 lakhs is 72 and 10% on 600 lakhs is 60. Difference between those two is 12 lakhs. Okay, you are saving for next 5 years each year 12 lakhs. But is this 12 lakhs before tax or after tax? This is before tax. So you have to subtract tax. Okay, but what are the costs? You are incurring 10 lakhs of issue expenses and 30 lakhs of you have your premium on redemption. Okay, no problem. Now, if you look at some of the problems that we've solved in the class and you look at the material also, there is a tax element on this. See, are these both tax deductible? Are they deductible in year 0 when things happen, or are they deductible over a period of time? So according to me, right, I think tax deductibility has to be there. You have to write an assumption, but there are 2 ways in which you can go about it. One is this premium has to be necessary. If an old debenture does not exist, there is no way you will get benefit of that particular premium tax benefit over subsequent period. So this 30 lakhs, you may get it instantaneously. But this 10 lakhs of issue expenses, you may wish to write off over 5 years. But cash outflow of 10 lakhs happens immediately only. But the tax benefit is spread over 5 years. Okay, this is the way I would think about it. But I have solved it in both the ways. That entire 40 lakhs, basically 10 and 30, entire 40 lakhs, you are going to get tax benefit in year 0. That is one assumption. In another assumption I have made, only on 30 lakhs you'll get benefit in year 0. So I have made 2 workings. So what is the present value of factor at 10% minus 20%? 8% already told you. What is the cash flow? Initially minus 40. This is cash flow. This is not a tax. Okay. And on the entire thing, you have a tax benefit of 20%. So minus 40 minus 20%, you basically get minus 32. Then every year you save 12 lakhs. Out of that 20, 20, 20, basically you get 9.6 lakhs. So all these 9.6 lakhs for 5 years, you multiply with the present value factors here given here for 8%. Okay. Post-tax cash flows have to be divided by or have to be discounted by post-tax cash rate. Post-tax discount rate. Okay. Post-tax cash flows divided by post-tax discount rate. So minus 32, and then you have this 8.93, all of this. You'll basically eventually see that there is a gain of 6.4. Okay, the NPV of a decision of refinancing when you get an entire 40 lakhs benefit upfront is about 6.4. Now, if let us say if you don't get this benefit, interest on old debt, what if you get don't get benefit on this 30? See, you'll incur entire cash flow immediately. Minus 40, but only on this 30 you get an instantaneous benefit. On the balance 10 you get 2 lakhs benefit each year. So 2 lakhs into 20% is basically you have 0.4 benefit every year, tax benefit. Okay, so what happens? First year you have 30 plus 10 40 minus tax benefit of only on 30, which is 6 lakhs. So 40 minus 6 is 34. So first year's cash outflow is 34. But in the previous case, what was it? It was actually directly 32 because you're getting tax benefit. Whereas from next year onwards, you get same 9.6, but you also add 0.4 every year. Okay, 0.4. Why? Because I just now told you, right? This 10 lakhs, you divide it by 5, basically you get 2 lakhs. On the 2 lakhs, you get every year 20% tax benefit, which is 4.4. So 9.6 plus 0.4 is 10. So you take 10, 10, 10, and then you take all the present value factors, you add all of them up, you'll finally get 6 lakhs. So here also it is go ahead. Here you got a benefit of 6.4. Here you got a benefit of 6. Okay. Not a benefit of it. Either ways, it is an NPV positive relation. You should go ahead. Now, some of you may have a different view. Please share your view. I'm more than happy to respond to that. Then, Mr. DK has 1,000 units of mutual fund of NAV. It is 17.5 per unit and 18.5 at the beginning and end of the year, respectively. The mutual fund has given two options. So please note, 17.5 is big. NAV is beginning 17.5, ending is 18.9. Okay. The mutual fund has given two options: pay 1.5 per unit as dividend and 1.2 as capital gain. Reinvest this distribution average NAV of 17.3. You are required to compute the holding period return percentage for both the options. Calculation up to 2 decimals. Like a super simple question, boss. So opening is 17.5, closing is 18.9. What is capital gain plus dividend? 2.7 under both scenarios. So they are saying under both scenarios, compute the holding period return. So under both of them, the return that you're getting, or rather the money that you're supposed to get or actually will get is same, 1.5 plus 1.2, which is 2.7. But in one case, you'll actually get it in hand. So 18.9 plus 2.7, closing NAV plus your dividend minus 17.5. You please note, the mutual fund has given options, pay as so and so as capital gain. So here the assumption that I'm making is this 18.9 is independent of this 2.7. So that's a very important assumption. Okay, so if 18, these two are already included in that, then it's a very different story. So you see here, I've assumed 2.7 not included in 18.9. This is a very important assumption. If you include it, then it's a very different story. But anyway, that answer will be different. So 18.9 plus 2.7 minus 17.5 by 17.5, you basically get 23.43. This is one answer. Second case, what will happen? You have 1,000 shares or 1,000 units, right? So on these 1,000 units, you'll get 2.7, which basically is 2.7 into 1,000, 2,700, which you will be allotted units at 17.3. They said no. NAV of 17.3. Reinvest and at NAV of 17.3. So you'll get how many units? 2,700 by 17.3, 156.0694. How many decimals, boss? They have said 2 decimals. Okay, anyway, I've taken 4 decimals, no problem. Total units is 1,000 plus 156, you get 1156.069, and the NAV is 18.9. So your closing value is 18.9 into 1156, which basically is 21,849.71. What was your opening value? Opening value was you invested 17.5. So 17.5 into 1,000, 17,500. The holding period return is 21,849 minus 17,500 by 17,500. You get 24.855. So which is better? Obviously, option 2 is better. Now, if someone takes, sir, this 2.7 is not included in 18.9, so 2.7 is already included in 18.9, it is paid out of that. Then what will happen? Then this 18.9 will become lesser here, and here also this 18.9 will become lesser, and then you'll get a revised number. Okay, you can work that out, but I don't think on the face of it, it doesn't look that is the essence of this particular question. This is my interpretation. If you have a different one, obviously, you will be getting a different answer. Okay. Okay, moving to the next question. What is the next question, boss? 4A. The following details are given for TC and PC stocks, Nifty index for a period. Okay, average return 0.12, PC 0.18, Nifty 0.6, variance is 5.8, 4.8, 2.1, beta 0.8, 0.7, proportion 50-50. Now, this, according to me, no, is not the right way. See here, this should be percentage. This is 12% and 18%. Then 0.12 is given in decimal form. So decimal you are converting. Then what is 5.8? Is 5.8 also decimal form, and this thing is, you multiply it with 100, 580. No. So here variance is 5.8%. This is a very bad way of framing question. But that is what I say is, in my opinion, this is what they intend. Okay. They come up with some other explanation. I really, would be worried as to how things can be like this. So this is decimal, convert to percentage. This is a percentage value given without percentage. And beta, obviously, these have their units, and proportion they've already given as percentage. Okay. You are required to calculate systematic and unsystematic risk for company stocks. What is systematic risk and unsystematic risk? See, your total risk, systematic plus unsystematic, your total risk is equal to systematic plus unsystematic, and total risk is variance. Variance equal to your beta square and variance of the market. Variance of a stock is beta square into variance of market plus unsystematic risk. So unsystematic risk has its own formula. You ignore that for now. But we have the total risk of the stock, and we also have market risk. So you can actually find out the unsystematic and systematic risk independently. So their stock variance is 5.8 and 4.8 variance. Please note, this is not stand deviation. and your market variance is 2.1 and 2.1. You have betas of 0.8 and 0.7. You arrive at beta square into market variance, which is basically 0.8 in whole square into 2.1 and 0.7 whole square into 2.1. You basically get systematic risk of 1.344, 1.029. That you subtract from total risk of that particular each security, which is 5.8 and 4.8. You get unsystematic risk of 4.456 and 3.771. You get total net unsystematic risk of 4.456 and 3.771. Now, are you supposed to give this unsystematic and systematic risk in variance form or standard deviation form? So I would say give it in variance form. If they're asking for standard deviation, because it is not clear, right? They just said, what did they say? Systematic, unsystematic risk. That's all. So you give it in variance form only. Okay. As far as I know, I mean, if they say that no, you have to give it in standard deviation form, I'd be surprised. Now, what is the second part of the question? Second part of the question is calculate portfolio risk and proportion is changed to 60-40. Which one is preferable? Which one is not? Use 3 decimal points. So, what is portfolio risk? Portfolio risk is your variance covariance wala matrix. But you can find, how will you find out covariance for these two stocks? There is a formula for covariance for these two stocks, which is covariance of two securities, beta 1, beta 2 market variance. So you do 0.8, 0.7 into 2.1, you get 1.17. You use that and put it in the A plus B whole square formula or that variance covariance matrix. What you do, sigma 1 W1 whole square, sigma 2 W2 whole square plus 2 sigma 1, sigma 2 W1 W2 R, and sigma 1, sigma 2 into R is basically your covariance, right? So you substitute this 1.176 there. So what you'll get 0.5 whole square into 5.8. See, please note, your standard, it is not given in standard deviation term. It is already given directly variance. So you directly multiply this, you don't do square again. And 0.5 square into 4.8 plus 2 into 0.5 into 0.5 into 1.176. You'll basically get 3.238. You can also give standard deviation form because they've asked, portfolio risk. So you'll get 1.8, basically this, if you do square root of it. Now, do you want to give a square root for your other things also? You may want to give, you can give. Okay, so 1.344 square root is 1.15, 4.456 square root, 2.11, okay. Then 1.029 square root, 1.014, then 3.771 square root, 1.94. So you can give this in standard deviation form also, or this is variance form, variance systematic, variance unsystematic. Okay, you can give it in that form also. Okay, then what is the last part? If they change the portfolio allocation from 50-50 to 60-40, 60 for the first one only, right? That's what they said. 60 for TC. Right? What is TC bus? TC is the first one only, no? First one is TC. So if they change the allocation, so 0.6 into 0.6 whole square into 5.8, 0.5 whole square into 4.8 plus 2 into 0.6, 0.4 into 1.176. So you'll basically get 3.444. Now, this 3.444, you can take a square root, you'll get 1.85, but that is not the point. What is the question that they've asked? Standard deviation 1.856. Okay. The question they've asked is, which is better, old 50-50 or new 60-40? See, on the face of it, right, risk is 1.8 versus 1.856. So the old one is better. But you take a decision, just come based on risk. If you just take based on risk, then no problem. You can take old 50-50. But if you also have to compare return, what is the return? Return is what? They've given the data here. They've given average return, 12% and 18%. Okay. So you take average of these two, because if it is 50-50, then it is 15%. Half of this plus half of this. 12 plus 18 by 2 is 30 by 2, which is 15%. If they have, 12% ka 60 and 18% ka 40, what will happen? You will get 14.4. That is 12% into 60. 18% into 40. This basically is 12 6 are 72, 7.2, 18 4s are 72, 7.2, 14.4. So you see here, for 15% return, you have lower risk, and 14% return, you have higher risk. So it is obvious that you will go to the one which has better risk return profile, which is your 50-50 variation. Okay. So you can give it answer based purely on risk, but also compare risk and return and then give it. Okay. If we had got a different one, then what will you do? If you had got, the return was higher here and the risk was higher, then you go for that coefficient of variation. Okay, right. Then B, Mr. SK buys 5,000 shares of P at 50 per share, whose beta value is 1.5, sells 2,000 shares of Q Limited at 80 per share, having beta value of 2. He obtains a hedge by Nifty futures at 1,000. He obtains a complete hedge by Nifty futures at rupees 1,000. So has he bought this Nifty, sold this Nifty? Not sure. Let us see. He closed out versus the closing price the next day when shares of P has fallen by 2%, Q is appreciated by 5. Achha, whatever he is bought fall, whatever he is sold has appreciated, both way loss, and Nifty futures also dropped by 8.5. So Nifty futures that is bought or sold, we'll see. You're required to compute the overall profit or loss to escape from these set of transactions. So 5,000 buy at 50 and beta of 1.5. So 5,000 into 50 is what? 2,50,000. 2,500 into 80 is minus 2 lakhs. So so basically we are trying to see whether it is, this is outflow, this is inflow. So not only this, you basically have to figure out what is going to happen to this Nifty. Nifty, is it a positive or negative? How will you find out? So you'll multiply this 2,50,000 into 1.5, which is which is plus 3,75,000. Why? 2,50,000 into 1.5, you basically beta, quantity into price into beta, right? You have the positive beta of 3,75,000 and minus 2 lakhs into 2, which is minus 4 lakhs. So you have a net negative beta of minus 25,000. So to that, your Nifty beta has to be positive at 25,000. So you have to buy 25,000 worth of Nifty, and each Nifty's contract is at 1,000. So you bought 25 units of Nifty. So it is buy 25 units buy of each at 1,000. Now, in this, right, day two, what has happened? You have sold your 5,000 shares, whatever you have purchased at 50, you have sold them at 49. 2,500 shares, whatever you have sold at 80, you have to buy back at plus 5%. See, 50 minus how much? 2%. 50 minus 2% makes it 49. 80 plus 5% makes it 84. Okay. So he has to buy now 2,584. He has to sell this 5,049, and he also has sold Nifty. See, initially bought Nifty at what rate? 1,000. Now the rate has fallen by 2.5%. 2.5% on 1,000 is 25. It has fallen. So it is 975. Because he's bought now, he has to sell. So he has to sell Nifty at 25. So see, there are two ways. In Nifty futures, no, when you do the futures, there is actually no cash outflow. But even if you consider cash outflow, okay, so I have actually done it without cash outflow also. Okay, but even if you just consider a cash outflow in the beginning and ending, what will happen? Initially your cash flow was what? 75,000. Considering that you purchased Nifty futures with some cash payment, assuming there's a cash payment. Okay, your outflow was 75,000. Why? You had 2,50,000 outflow, minus 2 lakhs inflow when you sold, and 25,000 outflow. So 2,50,000 plus 25 minus 2 lakh, you basically had an outflow of 75,000. Whereas when you're squaring off, you will get 5,000 into 49 outflow inflow, 2,500 into 84 outflow, and 25 into 975 is basically again inflow. So you get 59,375 as a net inflow. So your original outflow was 75,000. Subsequent inflow is 59,000. So net loss is 15,625. This I did it assuming that on Nifty futures also there's actually payment. This I did because in one of the previous question, I think November 24, they did like this. Okay. However, logically that is not the way. Even if you do logically also, you'll get the same answer, but the computation will be different, which is original you made investment of 2,50,000. Now you are going to sell it off at 2,45,000 because this is at 5,000 into your 50. This is 5,000 into 49. Then you made money of 2 lakhs, which is basically 80 into 2,500. Now you are buying it back at 84, same 2,500. So you basically outflow of 2,10,000. And in case of Nifty, right, you lose 625. Why 625? Because on each unit you lost 25 bucks and you had 25 contracts, 25, 25, 625. So minus 625. So initially your outflow was minus 50,000. Subsequently your inflow is 34,375. When you add all these three, so you have net flow of minus 15,625. According to me, this is the right way, but the way institute is, I've solved it the other way also. Okay. Now let us look at the next question, which is 5A. Sun Limited manufactures high quality modern furniture and sells to retail outlets in India and Nepal. Since the cost of quality wood in India is very high, the company is reviewing the proposal for import of wood in bulk from Nepali suppliers. This is actually a very similar question we've solved in class. Is there anything in steady material also? But the numbers have changed, obviously. The estimate of net Indian and Nepalese currency cash flows are as follows. So you have Indian cash, Nepali cash flow and Indian cash flow. Both of them are in millions only. Okay. Nepali cash flow is 75, 7.8, 11.4, 12.3. Indian cash flow is 0, 8.607, 12.6 and 13.8. Other information is as under. Sun Limited evaluates all investments using a discount rate of 8% per annum. All Nepalese customers invoice in NC. NC cash flows are converted in Indian currency, the forward rate and discount rate Indian rate. See here, the company is giving proposal import from Nepali suppliers. So it is very clear that they are based out of India. They're importing here and again selling back there. Okay. But the project, okay, the project basically importing of wood at 75 lakhs is what they are evaluating, right? all customers are invoiced in NC, and NC is converted in Indian currency. Inflation rates are given 8% and 6%. Current exchange rate is so and so. See, when they've given current exchange rate, no, and this is an international financial management, I actually always suggest that if you have a choice, don't take this question, because there are one, it is computation heavy. Second, there is scope for errors, right? And there's scope for interpretation also. Right. So you are required to compute the net present value of the proposal and show your recommendation. So what is this current exchange rate of 1.6 means? See, today 1 rupee is equal to 1 INR is equal to 1.6 NC. Now Nepal rate is 8% and India rate is 6%. Whichever currency has higher inflation rate or interest rate, please remember that exchange rate theories, one of them, their currency will depreciate. So if it is depreciating, 1 INR will become, let's say, 1.7, 1.8 NC as NC is depreciating. It is depreciating for how many years? You have to do for 3 years. Okay. So I require to compute the net present value and show your recommendation. So first is NC cash flow is how much? Minus 75, 7.8, 11 and 12. Correct? That only, no? 75, 7.8, 11, 12. And that you have to convert it into INR. So if NC is depreciating in INR, will you get same number or higher number? So let's say this 75. Initially you are dividing this by 1.6. Tomorrow you are going to divide by 1.8 or 1.8. So the cash flows will reduce. Okay, so what will happen is 70, first one you will divide by 1.6. So 75 by 1.6. You get 46.875. This is very good. Okay, but next year cash flow is 7.8 in Nepalese currency, right? This 7.8 you will divide by a number which is 1.6 into 1.08 by 1.06. Because what did I say? This depreciation will happen to this because Nepalese interest rate is high or inflation rate is higher. So 1.6 into 1.08 by 1.06, then 1.08 by 1.06 whole square, and 1.08 by 1.06 whole cube. So like that you get all these three numbers, and you divide this NC cash flow by these numbers. So I'll give you one example. 7.8, right? Divided by 1.6. You ideally should get 4.875. Okay, but 4.875 divided by 1.08 into 1.06. You'll get 4.785. Okay, so you'll get 4.7. From 875 becomes 785. Because you have again doing this multiplication division. Like that you do for every period. Okay, so then you'll get 6.86, 7.268, and then to that you add this INR cash flows 8.6, 12.6, and 13.8. These three. So you'll get total cash flows of minus 46, plus 13, plus 19, and plus 21. These again have to be present value. Present value at what rate? They've clearly said you're required to compute the net present value. All of this is in which currency? All of this is in rupee. Why are we doing rupee? Because they clearly said no, all investment using discount rate of 8% per annum. Okay, cash flows are converted to INR and forward rate and discounted Indian rate. Very clearly 8%. So you divide this by 8%. See, that is why they gave inflation rates different and interest rate different. You have to note this. Okay, so you divide this by 8% factor, for each of the years and multiply it with respective, cash flows what we got here. So you'll get minus 1.065. If you're getting minus 1.065, is the proposal worthy or not? It's definitely not worthy. So you actually have to write a conclusion. I forgot the conclusion. You see, they gave the values also here. 0.926, 0.857, 0.794. Please take that. So you have to write a conclusion. NPV negative, project unviable. NPV is negative. So you should not write like me. Okay, you're students. NPV is negative, and hence this project is unviable. So if you don't write this, you lose marks. Please be very careful. Okay, this is done. Next to 5B. In Raj, an investor made a lump sum investment in equity mutual fund at an entry load of 0.05. By the end of the year, NAV appreciated by 13.6. Additionally, the fund declared a total capital gain in dividend of 5 per unit, which were reinvested in year-end NAV of 25. As a result, investor held 15,000 units at the year-end. The fund also charges exit load of 1% if redeemed within 1 year, and investor is in 20% tax bracket. Inflation is 4.5. You're required to calculate. So, basic question. Most of you would have already read it. That's why I'm reading it fast. Calculate the number of units purchased by Raj at the beginning of the investment. Calculate NAV per unit, total investment made at the beginning of the period. Okay, calculate NAV per unit, investment made at the beginning. Appraise the return percentage, real return if we decide to exit the investment at the end of the year. So, this question, no, actually good quality question, slightly twisted also. We have one question like this, similar question, not exact same, but I think I've solved a very, very similar question. So, first of all, Let units be X, NAV be Y. That is how I proceed. We don't know how much he invested, at what rate he invested. We know the closing units is 15,000. They said very clearly. Closing unit is 15,000. Year-end NAV is 25. Okay. So your opening NAV plus opening units, whatever investment you made, into NAV plus 0.05, because they said that that is entry load is 0.05. So plus this will give you amount invested. So basically X into Y plus 0.05 is amount invested. Okay. Year-end NAV is, what is year-end NAV? They said year-end NAV appreciated by 13.6%. So this 25 of year-end NAV, is this, whatever is our NAV. What is NAV? Y. 1.136Y is equal to your 25. So, and then they have given dividend. What is the dividend? Dividend, they have said they have given 5 rupees, which were reinvested year-end NAV. So 5 into number of units. Okay, whatever number of units into 5 basically gives you 5x. And year-end NAV is 25. So units issued on reinvestment. How much units were issued? Whatever money that you've got as dividend, that is number of units into dividend per unit, 5x, 5 into x, 5x, divided by 25, which is the year-end NAV. So basically you get x by 5. This is the units that you've got. Now, your x plus x by 5, what is it? Your original units plus reinvestment units is equal to 15,000. So 6x by 5 is equal to 15,000, or x is equal to 12,500. You will get dividend of 5x. 5x you will reinvest at 25, which is basically your new units is x by 5. So x plus x by 5 is 15,000. So x is equal to 12,500. Okay, x is 12,500, and we also have 1.136 of your opening NAV is equal to 25, because your closing NAV is grown by opening plus 13.6%, right? So you will get opening NAV of 22.01. Now you've got opening units, opening NAV. Those were the first two questions. Then what is the second part of the question that they said? Calculate units purchased, we computed it, which is 12,500. Calculate NAV per unit, that also we computed as 22.01. Total investment, please don't directly multiply this 22.01 into 12,500. You also have to account for, what? You have to account for 0.05 of entry load. So 22.06 into 12,500 will give you 2,75,750. What is the redemption value? Redemption value is, you have this as 25 is the redemption value. And you also have an exit load of 1%. Exit load of 1%, they gave, no? Where is this? Exit load, 1% reading within 1 year. So 25 minus 1, basically the value that you will get is 24.75. 24.75, and how many units? 15,000 units. So you basically get 371,250. From that, you subtract 275, you get 95,500. So on 95,500, you take 20% tax is 19,100. So post tax, you get 76,400. What is the specific question they asked? What is the holding period return, or holding period, or what is the exact word? Periodical return. What did they say? Return percentage and real return. So what is the return? You have this 76,400 divided by original investment 275,750. Okay, you get 27.71 or 72 rounded off. That is real. That is nominal return. From that you have to adjust inflation, and whenever you have inflation, you do 1 plus by 1 by. Okay, 1 plus return by 1 plus inflation. So 1 plus 1.2771 divided by 1.045 minus 1, you get 20.2%. Last question, question 6A. What is 6A? This ABC share is currently trading at 192.5. Mr. Roni is planning to purchase the shares. For this, he is taking service of an analyst to know whether whether ABC is fairly priced. And analyst has done the following information. Pre-tax rate of return required on debt, preferred stock, and common stock. So debt, preferred stock, common stock are 8.6, 11, and 13. Okay. Company's target capital structure is 20, 30, and 50. Okay. Market value of debt is 275. Preferred stock is 120. Okay. ABC's free cash FCFF for the year ended is 125. This is FCFF 0. And is expected to grow at constant rate of 8%. Tax rate is 30%. They have 20 million outstanding common shares. Yar, common share kahan se hai? So what is this common share word? Common share is American terminology for equity shares. So our people have copied this from somewhere, and see here also common stock. What is that word? Where is this coming from? It's an American version. Okay, probably they picked it up from US GAAP or something. You are required to, as a financial analyst, on the basis of value per share, advise whether you should purchase the share of the company or not. Assume we have to get same value of equity as calculated in one using FCFE. Calculate FCFE for the year just ended if it is expected to grow at 8.5. calculation up to 2 decimals. Okay. Now we'll come to the second part later. First one, what they're saying is based on FCFF, right? Whether he should purchase shares or not. Now, what is FCFF? The share. FCFF, what is the value? See, if you do FCFF, you get enterprise value. And for how will you discover using similar method as Gordon growth model for FCFF, you will do FCFF 1 by WACC minus G. Right. So for you to find out WACC, you will use target capital structure or actual structure. You use target capital structure. So debt is how much? Equity they've given the costs of pre-tax cost of each of them. What is the target capital structure? Target capital structure is debt is 20, preferred is 30, and equity is 50. So 50, 20, 30. Okay. And they've given market values of both debt and preferred. They've also given the share count, right? Have they given share count? Yeah, 20 million shares, and they've given the share price also 192. So you are not supposed to do this on market value because they very clearly said you have to do it on target capital structure. Please don't. So I know some of the students, somebody messaged me also, sir, can we do this on market value? No, that's not the intent. You do it on steady state basis. See, free cash flow to the firm is basically expecting that you're going to get such cash flows going forward, right? That you will use using target capital structure, not actual market values of debt and equity. Okay. Now, so FCF they've given 125 and growth is 8%. Tax is 30%. No, they have mentioned somewhere tax. Yeah, tax is 30%. What is this tax rate used for? Tax rate is used for only your cost of debt, post-tax cost of debt. So what you'll do is WACC is 13 into 0.5, which is basically your cost of equity into capital structure. What is the weight? 8.6 into 0.7 into 0.2. And 11 into 0.3. You'll basically get WACC of 11%. WACC is 11%. Have they given any discount factors? No, they have not given discount factors. So we have to use 11%. Now, FCFF 1 divided by WACC minus G. So 125 into 1.08 by 11 minus 8. Why am I taking 8? Because they themselves have told FCF is expected to grow at 8%. So you get a value of 4,500 million. What is this? This is enterprise value. From enterprise value, what have they asked you to find out? They've asked you to find out the price of the share. Enterprise value minus debt minus preferred stock plus cash. Have they given any cash value here? No, they have not given any cash value. So you just subtract debt and the preferred whatever is the market value. They've given only your market value of 395, 275 and 120. So you'll subtract directly market value. So 4,500 minus 495 is 4105. 4105 divided by share count. What is share count? All this is in million, mind you. 4105 is equity value or basically market cap. Divide by 20 million shares. They only mentioned outstanding 20 million common shares. So divide by 20, you get 205.25. So intrinsic value per share is 205.25. What is the value currently it is trading at? 192. So is it a buy or sell? It's a buy, obviously. That is the question, right? What is the first part of the question? Whether you should purchase the share. Yes, you should purchase the share because it is at 202, whereas the market value is 192. So you have to basically write the statement. Buy as it is undervalued. Okay. Then what is the second part of the question? Now come to second part. After having done the working for the first part, only then you'll understand second part. Assume we get the same value of equity. What is the value of equity that we got? We got value of equity as 4105. Assume this is 4105. Then using FCF, then for using FCFE approach, calculate FCFE for the year end debt if FCFE is expected to grow at 8.5%. So instead of doing FCFF by WACC minus G, do FCFE by KE minus G and get the same value of 4105. You have cost of equity, you have growth. Growth rate they've given as 8.5. What is FCFE 1 and what is FCFE? So basically, FCFE into 1 plus G by 13 minus G. What is the 13? 13 is cost of capital of equity. And G is what? G they've given as 8.5%. So FCFE into 1.085 divided by 13 minus 8.5 is 4105. Find out FCFE. That is basically the question. They have asked you to find out FCFE, not FCFE 1. Okay. Assume you have the same value for using FCFE. Calculate free cash flow for the year just ended. So they are asking FCFE 0. So you do FCFE into 1.085 divided by 13% minus 8.5% is 4105, which is what we got 4105. And equate it and solve it, you'll get FCFE as 170.25 million. This is the answer. This is an interesting and good quality question if you honestly ask me. Now, coming to the last question. Now, Quick and Smart is a leading software development company in the UK. It has a substantial portfolio of its trade in various countries, including USA. It has recently invoiced a USA customer a sum of 75 lakhs. So it is a company in UK. It is invoiced in USD. Okay, it is invoiced a US customer. So I am based out of UK. I am selling to a US customer and I've also invoiced in US dollars. Okay, receivable in 1 year. Okay, after 1 year it will come. their chief financial officer is considering two alternatives for hedging. One, borrow present value of 75 lakhs for 1 year, converting amount into GBP and paying loan out of eventual receipts. So don't borrow 75, borrow present value of 75 of USD in USD terms. What is USD ka rate? They say, it will be there somewhere here. What is alternative to entering into 12-month forward exchange contract? The company's bank to sell USD 75 lakhs. So do a forward. Spot rate is 1.3288. Forward rate is 1.3128. Interest rates are USD 4.8 and 4.5 in UK 5%. So they're asking you basically money market rate and your forward rate. Which one is better? Money market hedge, money market rate, money market hedge. So what is the first thing? And they clearly said calculate net proceeds under both alternatives and advise, ignores commission and decimals and all that. Okay. So initially you have 75 lakhs, boss. 75 lakhs. Okay. Where is it? 75 lakhs. This 75 lakhs, they are saying you are going to get the money. Borrow today itself, it in dollars, present value of dollars, so that when the money comes, you can repay the loan using the export proceeds. So you borrow 75 by 1.045. Why 1.045? Because you're borrowing in dollars. Dollar rate is 4.5%. So you borrow 71,77,033. They said ignore decimals. So 75 lakhs divided by 1.045. You get 71,77,033. So you borrow this much money. So when you have to repay, how much will you repay? You'll repay 75. How will you repay that 75? By taking the export proceeds. Okay. Converted spot. What is spot? 1.3288. Please note, 1 pound is $1.3288. So 71 lakh dollars will give you lesser number of pounds, some 50 or something. So 7177 divided by 1.3288, you will get basically 54 lakh pounds. Okay, this is, you're getting this many pounds today. This is first action. Okay. Then you invest this money at 5%. Why? Because we are trying to compare everything at the end period. Okay, after 365 days, which is the credit period. So invest at 5%, you get 54,01339 into 1.05 divided by 1.3288. 54,01138 or 39 into 1.05, you'll basically get 5671196. Okay, this is the money you'll get after 1 year. Now you have to compare the other scenario where you do a simple forward contract at what? 3128. Right? They've only given 3288 and 3128. So you convert this 75 lakhs at 3128, you will get 75 lakhs divided by 1.3128. You will get 5712980. Okay. Now which is better? 57129 or 567? Obviously 57129 is better. So forward contract is better than money market. This is how you answer. Okay, so this is the summary of all the questions. I've given solutions. Now, if you have any different solution, any feedback, objection, anything you think could have been done differently, please share. And as I said, this is just my expected solution. How I say I will give, I don't know, but I'm expecting something in this form. Okay, chalo, please do like, share, subscribe this video, subscribe to my channel, and do reach out to me on comments as well as on my app OneFin if you have any queries about it. All the very best.